Hello students, welcome to all of you Shiksha 360. And today we have to cover the basics of credit part 2. In the previous session we have discussed regarding the basics like what is fund based, what is non-fund based, what is working capital, what is term loan, what is composite loan. Clear? All these things we have covered in the previous session. Today we will discuss some other topics regarding that. So let's start. First of all, we have to discuss what is DER. DER, that is debt, as its name suggests, debt equity ratio. That is means debt, it is in the numerator, in the denominator it is to be equity. That is debt equity ratio. So let's discuss regarding that. So what is that? This is the ratio between the debt and the equity. Clear? That is debt upon equity. What it indicates? Debt. What is the meaning of debt? That is basically how much we have taken the loan. Clear? What is the meaning of debt? That is how much loan we have taken. Okay. So it indicates the relationship. Clear? It indicates the relationship between the loan capital and the capital raised. Clear? So it indicates the relationship between the loan capital, how much loan we have raised, and the capital raised by the way of equity. Clear? Debt, that is loan capital. And second one, equity, that is capital raised by the way of equity. In the numerator, we take only long-term outside liabilities, that is known as debt. Clear? Long-term outside liabilities. The main difference between the loan capital and the equity is that the interest payable, very, very important point, that is the main difference between the loan capital and the equity, that is that the interest payable on the loan capital has prior charge. Clear? That the interest payable on the loan capital has a prior charge and has to be paid before any dividend can be declared. Clear? And has to be paid before any dividend can to be declared. Clear? Because this is the main liability. Okay. And has to be paid before any dividend to be declared, while there can be no dividend without profits. Clear? So in which case the company will pay the dividend to their customers. Clear? What is the case behind that? Only in the case of the profit. Clear? Only in the case of the profit. Even if the firm will face the losses. Clear? Even if the firm will face the losses, they have to pay the interest. Clear? They have to be pay the interest. Clear? So there is nothing, any condition on the interest, but for payment of the dividend, it has to be profit must. Clear? So while there can be no dividend without profits, so interest may have to be paid. Clear? Interest may have to be paid even if there is no profit. Clear? Interest may have to be paid even if there is a no profit. Okay. So please tell fast now if you are able to understand what is the meaning or what is the difference between both these things. Clear? That is dividend, it is to be paid only in the case of the profits, and interest we have to pay either there is any profit or loss. So what is the meaning of equity here? Equity refers to the tangible net worth. Clear? Equity refers to the tangible net worth. As the debt to equity ratio. Clear? As the debt to equity ratio expresses the relationship between the external equity. Debt to equity ratio, that is basically it tells the external equity, that is basically the funds which we have taken from the others, that is liabilities, and the internal equity. Internal equity, that is the stockholders equity. Clear? That is the stockholders equity. So sometimes it is also known as the external internal equity ratio. Clear? Sometimes it is also known as the external internal equity ratio. If a unit has more debt, that is numerator is more, so it may be a disadvantageous position as the servicing of the loan. Clear? If they are taking continuously more loan, more and more loan. Clear? So it will become very difficult for the firm for servicing of the loan, or we can say that for processing the business. Clear? Because continuously liability are going to be increased. So the optimal debt to equity ratio, it is to be 1:1. Clear? So the optimal debt equity ratio, it is to be 1:1. A capital intensive entity may have a high debt or equity ratio. Clear? May have a high debt equity ratio. Clear? So a capital intensive entity may have a high debt equity ratio. However, a low capital industry does not need to invest in the factories. Clear? Low capital industry does not need to invest in the factors and type of equipment. Hence, its optimal ratio should be around 1:1. Clear? 1:1. Clear? So, where it is less than one, oh, sorry, where it is more than one, that is, we can say that basically where there is more investment in the factory and the equipment. Clear? Because that are very much costly in the initial phase of the business. Clear? So, they have to be pay more there. So it depends upon case to case. Clear? It depends upon case to case. As they are already saying here, that is for a low capital industry does not need to invest in the factories and the types of equipments. Hence, its optimal ratio. Clear? In that case, optimal ratio should be around 1:1. Clear? So in that case, optimal ratio should be around 1:1. Okay. Now move to the next one, that is DSCR, that is debt service coverage ratio. Clear? That is debt service coverage ratio. Clear? So now let's discuss regarding that. So previous one, what is that is debt equity ratio. Clear? So please remember the difference between both of them. Clear? Debt equity ratio, that is debt upon equity. Clear? That is simple debt upon equity. Next one, that is debt service coverage ratio. Clear? Debt service coverage ratio. So what is the debt service coverage ratio? What is the meaning? That is, so debt service coverage ratio, basically it is a ratio of cash available, how much cash is available in our hands, to the cash required for the debt servicing. Clear? So what is the meaning of debt service coverage ratio? That is, it is the ratio of the cash available to the cash required. Ratio of cash available to the cash required for the debt servicing. This ratio indicates whether the earnings are adequate. Clear? So what this ratio? This ratio indicates whether the earnings are adequate to meet the burden of fixed financial charges. Clear? So what it indicates? Clear? So what this ratio indicates? So this ratio basically indicates whether the earnings are adequate. Clear? Whether the earnings are adequate or sufficient to meet the burden of, clear, to meet the burden of fixed financial charges. Okay, to meet the burden of fixed financial charges. So this ratio indicates whether the earnings are adequate to meet the burden of fixed financial charges. So now let's discuss further what is the formula of that. Clear? So simply what it says, that is what we are earning, that is sufficient for our business or not. Clear? Like we are taking the loan. Clear? Whether we are servicing our loan properly or not. Like you can see that basically in the banks. What is the main reason behind the, like we can say that SMA accounts? The main reason, that is basically they are not able to pay their interest. Clear? What is the main reason? That is they are not able to pay their interest. So it means that their earnings are not enough to meet the burden of financial charges or to meet the burden of the loan. Clear? That is they are not, they have invested properly. Clear? But the reason behind that, clear? What is the reason? There are many reasons. Clear? Like business is not going well, or they are not able to capable that do that thing. Okay, so there are many reasons behind that which we have to take care. Okay, so now let's further discuss what is the formula for that. So calculation of debt service coverage ratio, it is very simple. So how we can calculate? It is net profit after tax, net PAT. Sometimes you will find this word also. Profit after tax plus depreciation plus interest on loan, term loans upon interest on term loans plus principal repayment installment. Clear? Interest on term loans plus principal repayment installment. Clear? So what is debt service coverage ratio? That is, please remember that interest on term loan, it is to be common in both texts, in both the numerator and the denominator. Clear? So in the numerator we have depreciation plus PAT, that is profit after tax, and in the denominator we have principal repayment installment. Clear? And in the denominator what we have, that is principal repayment installment. Okay, this is the simple of the DSCR. So now what is the meaning of depreciation? Why depreciation? Clear? Depreciation tells the actual value of the equipment. Clear? What the depreciation? Basically depreciation tells the actual value of the equipment. So depreciation is added back to the operating profit. Clear? So depreciation is added back to the operating profit in the fund flow analysis. Clear? So depreciation is added back to the operating profit in the fund flow analysis in order to arrive at true funds. Clear? In order to arrive at the true funds, not friends, sorry. Depreciation is added back to the operating profit in the funds flow analysis in order to arrive at true funds from operations or real funds from operations. Clear? In order to arrive at true funds from the operations or real funds. Clear? So what is the actual value of that? Because every time there is a depreciation, it is to be going on the, like we can say that, on the instruments. So depreciation, it is a non-cash charge. Depreciation, basically what is that? It is a non-cash charge, and it does not reflect any actual outgo of a funds. Clear? Like we can say that we have purchased the machinery. Not like that. Presently, the cost of the machinery, we can say that it is rupees 10 lakh. So next year it has becomes, we can say that, like 9.5 lakh. So it does not mean that cash is going in our from our hands. Clear? Like this is the same thing here. Depreciation, it is a non-cash charge, and it does not reflect any actual outgo of the funds. Clear? And it does not reflect any actual outgo of the funds. So higher this figure, better is the debt servicing capacity. Clear? So higher this figure, better is the best servicing capacity. If the ratio it is less than 1, then it is to be considered bad. Clear? So if this ratio it is to be less than 1, then it is to be considered bad. As the ratio is more, it is to be better. Okay, that is, they have more profit. Clear? That is interest, it is to be common here. Clear? That is, after paying the interest on loan, term loans, and principal repayment installment, they have some amount left in their hand. That is their business, it is going well. Clear? Just remember this simple thing. So here one more point. So the acceptable norm for the DSCR, it is to 1.5 to 2. So what is debt equity ratio? Please tell fast. What is the acceptable norm and what is the acceptable, that is DSCR. General, what is, we can consider DER. What is the ratio under that? It is to be 1:1. And this is basically lies between 1.5 to. So please tell fast now. Both the points are clear to all of you regarding both these ratios. Definitely you will find questions from that in the examinations. These are one of the most important topics for the examination point of view. Please tell fast now. Move to the next one. Concepts related to the working capital assessment. Clear? We have not to discuss all these methods here today, but I will just tell you. Clear? So we sanction basically working capital finance basically to procure the current assets. Clear? Is to procure the current assets. So in this regard, we have come across like what are current assets, what is current liabilities, what is working capital gap, what is net working capital, what is current ratio. Clear? So these terms we have to discuss in this session. And what are the three methods? Clear? So basically there are three methods of assessment of the working capital. Very, very important for the JAB, for the CAB, or for the promotion exam. These three methods. Clear? In the upcoming session, we will discuss one by one each method in detail along with the question. Clear? We will cover that question also which they have asked in the examinations. So there are three methods of assessment of the working capital. First one, that is the MPBF method. Second one, that is the turnover method. Third one, that is the cash budget system. I think you will use these methods in your daily banking work also. Clear? For calculating the working capital. MPBF method, second one, that is the turnover method, third one, that is the cash budget system. Clear? Third one, that is the cash budget system. Clear? Which we have to cover also. Now move to the next one. Working capital cycle. Clear? Working capital cycle, that is operating cycle. So what is the meaning of that? Clear? Working capital cycle, that is operating cycle. What if, first of all, we have to understand what is the meaning of the operating cycle. Sometimes they will ask as a 0.5 mark question or 1 mark question, what is operating cycle? Clear? So the process involved in the utilization of working capital. Clear? The process involved in the utilization of working capital, basically it is a cyclical one. What is at one stage a raw material. Clear? What is at one stage a raw material gets converted into the goods in process. Clear? What is at a one stage a raw material gets in converted into goods in process in the next stage. Clear? First of all, what we have in our hand, that is the raw material. In the second stage, basically what it will comes into, that is in the goods in process. Clear? That is processing, it is to be going on. And the third stage, that is basically, and in the then into the finished goods. Clear? That is final, that is, it is the finished goods. Then book debts. Clear? What is the meaning of book debt? That is basically you are going to sell these goods in the market, and that is you are raising bills, that is you will have to receive payment from them in the upcoming period. And then cash. Clear? You will get the cash. You will find that in your branches some limits are basically, what is the stock under that stock is book debts. Clear? You will find that stock, it is book debts, which the money which you will receive from the market. Clear? The money which you will receive from the market, that is to be known as the book debts. And then cash, and again back to the state of the raw material. Clear? And again back to the state of the raw material. Clear? So later on, basically, what when you will get the cash, so what is the process going back? That is, you will now purchase raw material again for the complete working cycle. Clear? For the complete working cycle, now you have to purchase the raw materials again. Okay. So in a respect of trading concerns. Clear? So in a respect of trading concerns, operating cycle represents a period. Clear? So in respect of trading concerns, operating cycle, basically operating cycle represents the period involved from the time the goods and services are purchased. Clear? In respect of the trading concerns, operating cycle basically represents the period involved from the time the goods and services are purchased and the same are sold and realized. Clear? And the same are sold and realized. That is basically in the case of the trading concern, that is period involved from the time that is goods and services are to be purchased and the same are to be sold and realized. But in the case of the manufacturing concern. Clear? So in the case of the manufacturing concern, how we can include that? In the case of the manufacturing concern, basically what is that? It is a time involved in the purchasing of raw materials. Clear? In the manufacturing, that is, first of all, we have to purchase the raw material, converting them into the finished goods, and the same are finally sold and the proceeds are realized. That is basically we will get the amount. Clear? And the same are finally sold and the proceeds are realized. Clear? And the proceeds are realized. Clear? So this is the case in the case of the working capital. So management of the working capital. Clear? Management of the working capital means management of two things. Clear? So management of the working capital, basically it means management of the two things. That is, what are the two things in the working capital? That is current assets and current liabilities. Clear? So all the things that is in the working capital, basically it is going through two main things, that is current assets and current liabilities. So when the we are going in the profit or when we are coming in the loss, clear, this plays an important role which we are able to understand. Clear? So what is the current asset? That is how much money we have in our hands. Liabilities, that is what we are going to pay. Clear? What we are going to pay. So if we have more current assets than current liabilities, so just we can say that we are in the profit. Clear? That is, we can say that our business is to be going on good way if this is going to be happen. Clear? If this is going to be happen. Okay, so just please remember these basic things. Now move to the next point. So current liabilities. Clear? So what is the meaning of current liabilities? So current liabilities, basically what are that? Current liabilities are the short-term liabilities. Clear? So what is current liabilities? Current liabilities are the short-term liabilities. Current, that is basically less than 1 year. So current liabilities are the short-term liabilities which are repayable within a year. Clear? Which are repayable within a year. They are normally raised for meeting the working capital needs and to acquire the current assets. Clear? So they are normally raised for meeting the working capital needs and to acquire the current assets. Clear? So they are normally raised for meeting the working capital needs and to acquire the current assets. So current liabilities on that is, it is the are the main source of finance for the working capital and are normally identified within the operating cycle of the business. Clear? So current liabilities, what are that? Current liabilities are the main source of finance for the working capital. Clear? Are the main source of finance for the working capital and are normally identified. Clear? And are normally identified with the operating cycle of the business, clear, and are normally identified with the operating cycle of the business. So what generally current liabilities consist of, clear? So what generally current liabilities consist of, clear? So here current liabilities are the main source of finance for the working capital and are normally identified with the operating cycle of the business. So current liabilities normally consist of, first one, that is bank borrowings for the working capital, clear? So current liability basically mainly consists of bank borrowings for the working capital like OCC or bills. Second one, other short term borrowings like unsecured loans, sundry creditors like purchase of goods on the credit basis. Credit basis, that is like we consider it on cash basis. Term loan installments repayable within a period of 1 year, clear? For that it is also current liabilities, clear? I have already tell you that is current liabilities basically it means that less than 1 year, clear? Current liabilities, just please remember one thing, that is less than 1 year, that is it is to be considered under the current liabilities. So other current liabilities and provisions, clear? Other current liabilities and provisions, so all these things are to be current liabilities. So while making assessment of the working capital needs, we keep bank borrowings basically away from the total current liabilities, and we donate the balances current liabilities other than bank borrowings, clear? So generally, like if there is any bank borrowings, that is to be different, and other current liabilities are to be different, clear? Other current liabilities are to be different, and generally we can, what we can say, that if there is in the numerical like current liabilities, we have to calculate the total, like we have to given bank borrowings also, and under the current liabilities also, clear? So what they will use the word, that is CLOBB, clear? CLOBB, that is current liabilities other than bank borrowings, clear? Current liabilities other than bank borrowings, clear? So this word they have taken, clear? Generally we will take the bank borrowing is to be separate than the current liabilities, clear? Separate than the current liabilities. Next one, what are the current assets? So current asset, that is which we can easily convert into the cash, clear? So current assets are also called as the convertible assets, clear? Current assets are also called as the convertible assets, liquid assets, or floating assets, clear? So what are current assets? Current assets are also called as the convertible assets, liquid assets, or the floating assets. Current assets are, sorry, I will write same line here. So they change their form, every now and then, and ultimately are converted into cash, clear? So they change their form every now and then, and ultimately are converted into the cash. So current assets in the form of the finished goods, clear? Current assets in the form of the finished goods are meant for sale and conversion into cash in a period not exceeding 1 year, clear? So current assets in the form of the finished goods, clear? Current assets in the form of the finished goods are meant for the sale, clear? Are meant for the sale and conversion of cash, clear? And conversion of cash in a period not exceeding 1 year, clear? And conversion of cash in a period not exceeding 1 year, clear? So current asset basically here what is, that is it is in the form of the finished goods and are meant for the sale and conversion into cash in a period not exceeding 1 year, clear? And conversion into cash in a period not exceeding 1 year, that is comes under the current assets, clear? So now let's discuss what current assets basically will include, clear? Now what current assets basically will include? So current assets basically will include, that is cash, inventory, book debts, other loans and advances, clear? Other loans and advances which we have given here, clear? Which we have given to other persons. So what is the comes under the inventory? Inventory basically means that raw material, work in progress, sometimes it is also written as WIP, clear? So what it inventory? Inventory basically means raw material, work in progress, also called as the semi-finished goods or stock in process, finished goods, stores, packaging material, etc. Clear? All this come under the inventory, that is raw material, work in progress, finished goods, stores, packaging material. Next one, any asset held in excess. That is, we have raw material, just we require of 100 kg, but we have 500 kg. So that is excess, clear? That is excess. That is not beneficial for the firm. So any asset held in excess burdens the business with unnecessary interest and cost on such borrowings, clear? So any asset held in excess burdens the business, clear? So any asset held in excess burdens the business with unnecessary interest and costs on such borrowings. So what are current assets here? I will write it the two formulas, current assets and current liabilities. Current asset, that is what we have the stock, what we have receivable, that is which we have to come from the other person, and other current assets. And under the current liability, that is creditors, clear, who have already give payment to us, or we have taken raw material from us and we have to return back. That is creditors, other current liabilities, and bank borrowings, clear, and bank borrowings, clear. So that is to be comes under the current liabilities, clear. So please remember both these things, that is stocks, receivables plus other current assets. You will find these things helpful while calculating the numericals. Current liability, that is creditors, other current liabilities plus bank borrowings, clear. So these are the current liabilities. So last one, that is the one net working capital, which I will cover in the next session, clear, which I will cover under the next session. Net working capital and what is working capital gap and what is current ratio, clear, which we have to cover in the next session. So please tell fast all the points whatever we have discussed with you. It is clear to all of you, like what is working, sorry, what is debt equity ratio, what is debt servicing coverage ratio, all these things, and what are current assets and what is current liabilities, clear. So I request to all of you, please go through all these terminologies properly, and I will upload the slides in the group so that you can go through that, clear. So in the next session we will cover both the things. Along with that, we will cover some other important points and try to cover one or two numericals in the next session. So thanks to all of you for joining this session.